Hi, and welcome to Your Financial Bud, where every week you can get personal financial ideas and tips from a certified financial planner, which would be me. I'm Bud Milligan, CFP professional and wealth manager with Milligan Wealth Management. I manage the wealth for many families in many different states, and I've created this channel so I can reach more people and families with solid weekly content. From a licensed professional and not someone who's just read a book or Googled something on investing in personal finance. November is Long-Term Care Awareness Month, so this is the first of a two-part series on long-term care. Today, we'll discuss how to integrate long-term care into your retirement planning and how you can protect your savings, your lifestyle, and your loved ones. Stick around and I'll share the importance of long-term care planning, the options available, and crucial mistakes to avoid. Our next video will cover long-term care cost projections and funding strategies, so you don't want to miss that one either. If you're approaching retirement or already retired, ask yourself this important question. Have you considered how you'll pay for long-term care if or when you need it? Most Americans haven't, yet the statistics are clear and sobering. 70% of people over the age of 65 will need some form of long-term care in their lifetime. And the price tag? Well, a private room in a nursing home now surpasses $108,000 per year, and I'm sure it's higher than that by now. Even basic in-home care often exceeds $75,000 annually, a number that's climbing faster than overall inflation. You might think, long-term care, that's for much later. But here's the reality. Nearly 7 out of 10 people over the age of 65 will require care for daily activities like dressing, bathing, or eating due to illness, injury, or cognitive decline. And this isn't just a brief phase. About 20% will need care for 5 years or more, especially women, who on average need care longer than men. If you're envisioning retirement as years of independence and enjoyment, you're not alone. But without a care plan, even a most well-funded nest egg can be depleted shockingly fast. In 2025, home health aid averages $75,500 annually, and a private room in a nursing home can run more than $116,000 per year, and it's higher in some states. Costs have risen at about 5% a year, and that outpaces most retirement portfolio growth rates. Traditional health insurance and even Medicare don't cover these extended costs. Medicare only pays for brief, medically necessary rehabilitation after hospital stay, not ongoing assistance with daily living. So, what happens if you're not prepared? Like millions of families, you could face difficult choices, and I see this all the time. Draining savings, selling assets, putting pressure on adult children, or restricting care to what Medicaid will pay for after you've spent down your resources. Let's talk about traditional long-term care insurance. This coverage reimburses you for the cost of care, whether at home, in assisted living, or in a nursing facility, once you're unable to perform at least 2 activities of daily living or face severe cognitive decline. Traditional long-term care insurance used to be much more common, but as claim costs outpaced early insurer assumptions, many companies exited the market, premiums rose, and coverage became harder to get. Now, only about 7 million Americans have such a policy, and that's less than 10% of those aged 65 and up. There are some crucial caveats to keep in mind with long-term care insurance. The first is that you have to qualify based on your health. About 38% of applicants age 65 to 69, and nearly half of those that are 70 to 74 are denied due to medical issues. And again, I see this all the time. Policies generally have an elimination period, a waiting period. So if you need long-term care insurance right away, there's typically about a 90-day waiting period before those benefits kick in. And if you never need long-term care, your premiums are not going to be refunded. This brings us to a modern alternative known as hybrid policy. These are fast-growing solutions that package life insurance or annuities with long-term care benefits. So, how do hybrids work? Well, first you have life insurance hybrids, and with this you buy a permanent life policy with a long-term care accelerated benefit rider. If you need long-term care, a portion or sometimes all of your death benefit can be accessed tax-free for care. Whatever you don't use for long-term care goes to beneficiaries. Another type of hybrid is called the linked benefit plan. And typically, you pay a linked benefit plan with a single premium or fixed payments over a set term. And these offer both a pool for long-term care and a guaranteed death benefit if care is not needed. Finally, there are annuity hybrids. Certain annuities now offer an enhanced income stream if you need long-term care, essentially doubling or even tripling your annuity payout for a period if a major health event occurs. Now, there are some potential downsides. There are higher upfront costs with these policies than traditional long-term care insurance, but they do provide more flexibility. Cash value and death benefit can be eaten up if you need prolonged care. You must satisfy certain health criteria, though it's often less stringent than standalone long-term care insurance. So let's talk about self-funding. This is a common choice for retirees. Some retirees do choose to self-fund their long-term care risk using personal savings, investments, and home equity. But is this realistic? So let's look at the numbers. Average long-term care needed, 2.5 years for men, 3.6 for women. And it even crosses into 5 years for some, about 20% of retirees. 3 years in a nursing facility at today's national median, $116,800 a year, is more than $350,000. That's not counting the rising cost of care or unpaid family support. Many people who try to self-fund lack sufficient liquidity, and they end up draining accounts set aside for travel, hobbies, or legacy goals, or retirement. And for any plan, the key is to model different care succession scenarios and stress test your retirement income. So as a wealth manager, that's what I do. I take your data and I run Monte Carlo simulations to check your care resilience, as we call it. We can examine where you are right now and compare these options together. For most Americans, Medicaid is the payer of last resort for long-term care, but qualifying requires that you've spent down most of your assets, often to less than $2,000, and it does vary by state. And there's typically a 5-year look-back on gifts or transfers, and that prevents sheltering assets right before care is needed. Medicaid covers nursing homes, but not all assisted living or home-based options, and it often requires tough compromise on facility choice, on privacy, and speed of admission. Planning ahead, let's say 5 or more years before a health crisis, allows for more flexibility and a better outcome. But be careful here. I've seen a lot of families counting on doing this only to discover that you really can't predict when this 5 years before a health crisis occurs. And then they lose that legacy that they had planned on passing down to their children or their loved ones. Practical steps you can take when looking at long-term care planning for your retirement. The first is to start the conversation early, preferably in your 50s or early 60s. Premiums are lower, more options are available, and health screens are easier passed. Number 2, work with a team. A certified financial planner provides comprehensive advice, and they know how or when to collaborate with an estate attorney or CPA to coordinate with your estate and tax planning. Number 3, assess all of your funding sources. Look at your health savings accounts, your retirement accounts, your home equity, and insurance. They all play a role. Number 4, get the right policy if appropriate. Consider a traditional long-term care insurance policy, a hybrid, or an annuity with long-term care benefits based on your age, your wealth, and health and goals. Let's make sure the story of your retirement has a strong, secure ending, not a crisis halfway through. And here's your next step. Meet with a wealth manager who understands the spectrum of long-term care strategies. Bring your existing investment plan, your estate documents, and insurance policies, and then work together to craft an integrated, personalized solution. Go to my website at milliganwealth.com, click on the Let's Talk button, and let's schedule a few minutes together. I can help you bring clarity to this process, and there's no obligation and no cost to you, so what do you have to lose? Hopefully by now, you have a good idea of what the cost is to not do anything. Don't wait until a crisis hits. The confidence you gain by being proactive is one of the greatest gifts you can give yourself and your loved ones. If you found this video helpful, please like, subscribe, and share it with others. Thanks for joining me, Bud Milligan, your financial bud, and I'm here to help you navigate retirement confidently.